What's up, everybody? This is Sunko, the Korean Bro. Today is 2024, February 8th. Okay, let's see. Hmm. A bull market is here. Two AI stocks to buy like there's no tomorrow. Top AI stock could deliver significant outperformance for investors in the next decade. Super microcomputer. NVIDIA recently saw revenue growth spike to triple-digit rates. Okay. Super microcomputer. Hmm. Okay, share prices of supermarket computers soared 246% in 2023 and have already doubled year to date in 2024. The latest quarterly update from the provider of rack mount data center solutions shows why. Revenue grew 103% soar year over year to $3.66 billion, a massive acceleration over the previous quarter's 14% revenue growth rate. As AI innovation accelerates, more customers are investing to expand their AI infrastructure. This means more demand for supermicros plug and play rack systems, which are the building blocks of data centers. CEO Charles Liang said he is very confident that this AI boom will continue for another many quarters, if not many years. What's more, Supermicro is profitably growing. Adjusted earnings per share came in at $5.59, up from a $3.26 in the year ago quarter. New graphics processing units from NVIDIA and advanced micro devices will expand Supermicro's offering in the near term. As the business expands and wins market share, it should increase margins. Analysts expect Supermicro to grow earnings by 37% per year over the long term. This is plenty of growth to support the stock that trades at the forward price to earnings ratio of 27. This is plenty of growth to support the stock that trades at a forward price earnings ratio of 27, which is not that much higher than the S&P 500 average. The stock could hit more new highs in 2024. So Nvidia stocks rocketed 239% in 2023. Supermicro's earnings report was great news for Nvidia's booming data center GPU business. AI rack scale solutions designed for deep learning and large language models using Nvidia's HGX 800 were key sales drivers for Supermicro. This bodes well for continued growth this year from the leading AI chip supplier. Analysts expect Nvidia's annual revenue to reach $109 billion through the company's fiscal year ending in January 2026. That is more than double the trailing 12-month revenue of $45 billion. Analysts expect earnings to grow 42% per year, which could support new highs for the shares. The stock's valuation sits at a forward PE of 32, which is quite attractive considering the company's growth. NVIDIA benefits from the high margin sales of advanced GPUs for AIs. It's also seeing growth in recurring revenue from software, which is up to $1 billion on an annualized basis. This is plenty coming from NVIDIA. AI Enterprise, a software suite that helps organizations streamline the development of AI applications. So, generative AI is a huge opportunity for the global economy, which spells more investment in NVIDIA's GPUs. Goldman Sachs estimate generative AI will increase global GDP by 7% over the next decade. So, NVIDIA is already working with NVIDIA's government and largest tech companies to develop their sovereign AI infrastructure. Given these powerful trends, the stock sells for what seems like a low valuation against the company's revenue and earnings growth. It's not too late to add this top GPU stock to your portfolio. Stock. Okay. Stock. Mm, Dividend providing an annual yield of about 0.4% at its current stock price. The decision to pay a dividend signals management's confidence in the future earnings for Meta. When other big tech companies initiated dividends, they continued to grow rapidly and attract new investors, signaling a lot of confidence. Okay. DraftKings. Okay. Is a leader in the rapidly expanding sports betting industry, putting it in a position for long-term success. All it takes is watching a televised sporting event through a couple of commercial breaks to see the surge in popularity of sports betting. Whatever the network or event, there are ads and partnerships promoting something most sports leagues shunned until fairly recently. One of the biggest beneficiaries of the surge in sports betting is DraftKings. Okay. Apple is a name that needs no introduction, and while growth rates may not be what they were several years ago, given the ongoing changes in discretionary consumer spending, this is a business that continues to pack a powerful punch in a wide range of market environments. Not only does the company control an incredible 25% share of the smartphone market, more than any other competitor, but also just reported another quarter of record business milestones. As of Apple's fiscal 2024 first quarter ended December 30, 2023, had more than 2.2 billion active devices installed for customers worldwide. The figure represented a new record for the business. Apple's net sales and profits in the first quarter were driven primarily by iPhone sales and a new sales milestone in the company's services segment. So, while Apple is known for its hardware devices, the latest addition being its just launched Vision Pro headset that runs for a cool $3,500. The company's subscription-based services division is slowly but surely accounting for more and more of its overall growth. The segment includes products like Apple Music, Apple TV Plus, Apple News Plus, Apple Fitness Plus, app purchases from the iTunes Store, and advertising revenue. In the first quarter of fiscal 2024, Apple reported net sales of about $120 billion, up 12% from a year ago, and net income of $34 billion, a 13% year over year bump. Of the net sales total, $70 billion came from iPhone sales, while $23 billion was attributable to its services segment. In other words, these two segments combined comprised more than three quarters of Apple's net sales in a 3 month period. Apple also reported earnings per share of $2.18, up 16% from 1 year ago, and a new company record. Plus, the company has been an extremely reliable dividend payer through the years. Despite the stock having a yield of 1%, Apple has raised its payout by approximately 120% over the past decade. Apple's dominance of the smartphone market, its broad collection of other market-leading hardware products, and continued adoption of its asset-light subscription-based services are enabling robust performance on both the top and bottom lines. If you're looking for a stock to buy, hold, and keep adding to through the years, Apple seems like a no-brainer contender for your buy list. American Express been 5 years, bringing on younger cardholders who are spending at a faster clip than other demographics. Management expects business to push double-digit revenue and earnings growth over the long term. The current valuation is in line with its trailing 5 year average. Predictable and durable business model. In the past 5 years, American Express stock has doubled, climbing 100%. What is American Express? American Express. hold on. Global payments company that primarily offers credit and charge cards to consumers and businesses. American Express is a credit card issuer processing network for its cards. The company's primary source of revenue is card processing fees charged to businesses that accept Amex. Okay. Mm. Oh, there you go. Shopify. Here we have those market beating stocks could be just getting started. The investing war at two Baga refers to a stock that gains 100%. That is, it doubles your initial capital. Doing so in a mere 5 years is no easy feat. It requires a compound annual growth rate of about 14.9%, which incidentally is pretty much what the S&P 500 has posted the past half decade. However, this has been in an unusual period. The broader market's average annual return is usually below the level. So returns of this type are by no means a guarantee. But if I had to bet on two stocks doubling my money in the next 5 years, Shopify and Axon Therapeutics will be on that list. Read on to find why. Shopify has more than doubled investors' money in the past 5 years. That is no guarantee it will do so. Again, still a few things are worth pointing out. First, the company's shares soared early in the pandemic. When the e-commerce industry got a boost due to the outbreak, Shopify gave up much of these gains between late 2021 and 2022, but has recovered over the past year. Second, Shopify. Shopify made significant changes to its business in 2023. Wait, hold on. Soared early in the pandemic when the e-commerce industry got a boost due to the outbreak. Shopify gave up much of these gains between. Okay. One of the most important was to divest its logistics segment to focus on its core e-commerce operations. The move will almost certainly boost margins and help the business become consistently profitable. The persistent writing on the bottom line and Shopify's seeming desire to pursue growth at all costs had long been one of the bears' arguments against the company, making this move all the more critical. So, what do the next 5 years have it in store for Shopify? The company should continue to profit from the fastest growing e commerce industry, where it has become a leader. Shopify offers merchants everything they need to build and customize online storefronts, as well as sell their products on various social media sites. It also provides single integrated brick and mortar and e commerce payment platform. Shopify benefits from a switching cost. Merchants will be hesitant to switch to a competing provider after spending time, energy, and money to build an online storefront from scratch with Shopify. The company is also investing in various initiatives, including artificial intelligence centered changes to its platform to make it more efficient for merchants. Shopify is also likely to become consistently profitable in the next 5 years. For the first 9 months of 2023, Shopify's net loss per share shrunk to $2.41 versus $2.24 in the comparable period of the previous fiscal year. Meanwhile, the company's revenue grew by about 27% year over year to $4.9 billion, with the top line still increasing at a good clip, as well as improvement in the bottom line and margins. Shopify could once again more than double investors' money in the next 5 years. Okay, done with motleyfool.com. Move on to yahoofinance.com. Okay. Okay, let's read about PayPal Holdings. It's Palantir, Supermarket, Upstart Holdings. Here it says Upstart Holdings is listed as one of the AI stocks that you have to buy, but then uh, it's not. But well, recently it hasn't gone that much upward. It's going mm, like up and down, up and down. It's not like bullish or bearish, but it just stays steady. So let's read this one. PayPal is one that I invested, and like it's not gaining that much profit. Um, and it has weak guidance. PayPal. Wait, PayPal. Hmm. Okay, PayPal tumbles after firm forecast little profit growth in 2024. PayPal Holdings shares stumbled late Wednesday after the company said it expects earnings to be flat this year as it continues to cut costs and streamline its operations. Shares of the fintech firm slid 7.9% to $58.24 at 6:28 p.m. in New York. The stock has gained 3% this year through the close of regular trading. Fourth quarter payment volume climbed 15% to $49.8 billion, beating analyst estimate of $403.6 billion. Adjusted earnings per total of $1.48 a share, topping the $1.36 average forecast. For all of 2024, PayPal expects adjusted earnings of $55.10 a share, unchanged from last year, the San Jose, California-based company said in a statement. It will cut about 9% of its workforce, part of Chief Executive Officer Alex Christ's efforts to boost profits in November. He blamed PayPal's slow progress on its cost base and complex structure. The company still has ample expenses that can be reevaluated beyond its headcount as it works to become more efficient. Chris said in an interview, we're continuing to look across the entire organization. The firm plans to buy back at least $5 billion of its stock this year. Chief Financial Officer Jamie Miller said on a conference call with analysts, fourth quarter net revenue totaled $803 billion, up 8.7% from a year earlier. Transaction margins, dollars of revenue minus transaction costs and the transaction and credit losses divided by net revenue. Okay, let's read on why Kathy Wood just bought Tesla again. It's been a bad start to 2024 for Tesla shareholders. So the stock's trading 26% lower this year, right? Off 38% from last summer's high. Price cuts on its electric vehicle last year and a disappointing financial report 2 weeks ago aren't helping. The shares opened lower on Tuesday after Jareem Nathan Adawaya downgrade Tesla to neutral from outperform, slashing its price target from 245 to 195. He feels that the recent corporate governance concerns related to CEO Elon Musk could get in the way of Tesla making long-term investments, as well as its ability to innovate. Bloomberg would go on to report on Wednesday morning that Tesla employees are starting to worry about layoffs after sources as managers were asked to identify which jobs at the company were critical. The EV pioneer remains Wu's second largest position across all of our invest stakes. How they compare with Wall Street expectations determine their next move. Some key metrics always offer a more accurate picture of a company's financial health. Since these metrics play a crucial role in driving the stock top and bottom line numbers, comparing them with the year ago numbers and what analysts estimate about them helps investors better project a stock's price performance. Mm. PayPal sees flat profit and transaction year shares fell. Okay, anyway, mm, still, still some writer from motleyfool.com still recommends PayPal, although a lot of people have weak guidance for it. So let's see why that is. It's still, from what I know, PayPal is like the market leader in this in their own territory, and probably that's the reason why. And plus, on top of that, it's been uh, down by like 80% so far. It's been down by 80% from all time high, and probably that would be the reason why he recommends, because PER perspective, it's pretty low. Mm. PayPal is still trading down by around 30% from 1 year ago, although the stock is slightly up from its position at the short of 2024. Concerns about competition with other payment services have slowed down in growth. Okay, concerns about competition. Okay, uh, a slowdown in growth from a few years ago and dampened enthusiasm for many investors toward fintech stocks compared to the height of the pandemic have all been factors. As always, when you're looking at a company to invest in, you need to think about it in terms of its business, not just whether the stock is up or down. Share price going up or down and of itself tells you very little other than what investors value the stock at a given moment in time. If you're considering buying and holding a stock for the long term, that means you're going to become a part owner of the business. Looking at PayPal specifically, while growth has slowed from previous periods, much of this is a function of the macroeconomic landscape in which the business is operating rather than a negative quality attributable to the business itself. As a leading payment processing provider, PayPal is heavily dependent on the trajectory of consumer spending. The broader fluctuations in discretionary consumer spending have impacted the business too. While competition is ramping up in this space, Consider that PayPal still accounts for roughly 40% of all online payment processing that occurs globally. That's pretty wide moat to rely on as it builds future growth. PayPal has still reported some impressive growth figures lately, despite the difficult environment in which it's operating. Total payment volume rose 15% year over year to $388 billion in the most recent quarter, when the revenue came in at $7 billion at 8%. Hmm. Okay. Now let's move on to you know, CNN business. Okay. Mm. U.S. companies are still worried about an economic shock. New York Community Bank stocks prices plunging, but that won't tell you if it's on the brink of failure. Anyway, today this is it for today, and I'm gonna see you tomorrow. Okay, bye bye, and have a good night. Okay, bye bye.